index that's managed to open with some bit of a gain of 0.4%.
NSE, as part of its November index review, has gone ahead and added 5 Indian stocks.
40-day exponential moving average comes into play, 24,740.
So the bounce that we saw on the Nifty, was it a dead cat bounce or is there more in store?
0.15, 0.2% lower, 24,420, 430.
We should break even within the first year.
A set of tariffs being imposed. Most likely it is going to be targeted on China.
Bringing down this expense ratio, and there has been improvement in last 3 years.
As the screen shows you, it's still deeply in the red, 1% gone on the frontline indices.
Markets continues to be challenged, particularly because of the problems in Germany.
Profit up 13% from last year, marginally higher compared to estimates.
Stocks slip as uncertainty rise over the policies of US President Donald Trump.
Sharpest strategies, top market trends, unmatched perspectives, the trading day's most comprehensive roundup. Stay ahead with NSE Closing Bell, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
It's almost as if yesterday it did not happen, because today the market is giving back all of what it went up by. I mean, it's a complete reversal, at least on the Nifty. This is Closing Bell. We're coming to you as always from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Reema, Surabhi, Nigel is joining us from the newsroom floor. Guys, hi, good afternoon.
Hi, good afternoon. And it doesn't help when the bellwethers of the India growth story, stocks like Trent, are down 7.5%.
You know, yesterday we were calling it honeymoon, so whether you call it first love, honeymoon, whatever you call it, it was really
a quick breakup.
Yeah, it didn't last too long. Nigel?
I've got a better one. you know what happens after a too heavy party, right?
It's a hangover.
I mean, I think hangover is better than a breakup, right?
Yeah, it is a hangover.
Yes. It depends, actually.
Okay, I think we'll pick up on that point, the nuances of that actually a little later.
And you're laughing.
All right, well, so the market is giving up the gains yesterday, and we are, by the way, at the lowest point. So 24,204 was the low yesterday, and guess what? We are around those levels as we speak, 24,201. I mean, market's been treading water around those levels from the morning. Of course, if you look at the day's low, it was a clean break of yesterday's low, but then there was a bit of a bounce and we are back around where the low was. Now, supports, that, of course, it'll be nice if that level holds, which is 24,204 by close. But next support under where we are now is 24,075. There is point number one. Metals, pharma, energy. These are the three areas, three pockets which are seeing the most in terms of a pullback. PSU banks as a pack is outperforming. I mean, actually, I think it's the only sectoral index which is up in the green. Very little, but it's up in the green. And that's been the story of this earnings season. If you want to pick up one sector which has done well, it's PSU bank stocks. Now, I said this in the morning as well. It's not possible that you get a 15, 16, 20 basis point jump and markets, sort of equities rally as well. For the second day in a row. I mean, of course, last night, it was like a one-way thing. Everything went up, yields and equities. So I think a little bit more focus on bond yields and whether they are ready to maybe hold where we left off, which is about 4.5% on the 10-year, or actually, maybe even pull back a little bit. In that regard, a 25 basis point cut later tonight is consensus, but the guidance, I think, becomes more important. Will they be able to give very much in terms of a guidance with this complete sweep and change of sort of power in the US? I think that also kind of remains to be seen, but extra sensitive because, of course, what has happened with bond yields. By the way, from the time that the FOMC cut, the first time, that 50 basis point cut, I think bond yields are up 120 basis points. Policy cut of 50 and actual market rates going up about 120 odd basis points. So it's a pretty big kind of divergence out there. Reema.
Two big macro risks or events on the horizon for our markets. And today, as Prashant pointed out, it's a complete reversal. Right now, Nifty is below 24,200. A quick check on the large caps and how they're moving on the way down. It's Hindalco. It's been the top loser since morning, still down 8.5% as Novelis's numbers disappoint. Trent numbers were in line. But I guess the lofty valuations of 90 times forward multiple, high growth expectations, so a 39% revenue growth results in the stock slipping 7.5%. But, Mangalam tells us the numbers were in line with expectations. Shriram Finance, Grasim, Tech Mahindra, so some of the IT names are also giving up yesterday's big rally. Adani Enterprises, Tata Motors ahead of numbers tomorrow under pressure. On the way up, it's Apollo Hospital standing tall. In fact, that's the only Nifty stock with a gain of more than 1%, 6.5% higher on Apollo Hospital, strong Q2. Good pickup in occupancies, and SBI deserves mention. I think that's the only large cap bank in the green right now, and it's up 0.5%.
I think the reaction to trend is really telling a story. Not just trend, even the reaction to Mahindra and Mahindra. Yeah. Was there anything wrong with the numbers? Absolutely not. I mean, stellar performance continuing. Their tractor business, that turnaround that they promised is going as per script. It's phenomenal. The margins are picking up in the tractor business as well. The stock's not fired up. So for me, some of these larger reactions, and like you said, 40% growth on trend, it's not bad. Margins also slightly gone up. It's telling you about the market psyche and the nerves that still exist out there.
I asked Mangalam, is this a miss, right? 39%. Is it that growth has slowed down? And he said the last 3-year average growth rate is 37%. So it's in line. It's just that the market was used to beat, a beat.
But I'll tell you two things. Now, not explaining the fall, but last quarter growth was 57%. So 57 has become 40. That is one. And even after the 20% correction from the fall, guess what the P multiple is? 127 times.
That's the problem.
That's the problem.
And that's the problem. And therefore, and now put in context, I should have actually put this quote out. So the Chinese Commerce Ministry made a statement today. The Chinese market, by the way, has rallied 2%. The Hong Kong market, the mainland Chinese market has rallied. And I think the guessing game or the chatter now is that will it not be as bad or as severe for China? I mean, Trump, it's anyone's guess. It's a big, question out there right now. We're moving towards perhaps more stimulus by the end of the week from China. Just pull up the Hong Kong market if we can. And here's the quote that came in from the Ministry of Commerce spokesperson. He was asked by reporters saying, what do you think of Trump? And he said the Chinese side is willing on the basis of mutual respect, peaceful coincidence and win-win cooperation to increase communication with the US, expand cooperation and resolve differences. On foreign policy, a lot of these things are overtures, but the fact that these are the kind of sounds and the noises that are being made, maybe it'll get people, traders will punt. Traders will take punts and trades on either side. And right now, the pullback in China is also telling us a story. But it's early days. It's anyone's guess right now. Anyway, to come back home here to complete the picture, the large cap sell-off 300 points down. Mid caps are relatively better off with the advanced decline ratio. It's still negative, but the index is not falling as much. And then there are the banks, which are also weak. But yeah, I think it's still murky, Nigel, this whole global picture. And then we have our own earning situations, valuation situations, like we were discussing here in the studio.
Well, that's right. But Surbhi, what if, the Fed doesn't cut rates tonight? What's going to happen to the Fed chair?
You're going to stay up and watch?
No.
Tonight, Nigel's staying up and watching.
I thought you were going to quote what one of our guests said yesterday.
Mr. Ramesh Damani. Yeah, he doesn't have an option. Otherwise, he'll be fired. He'll be asked to go. He'll be put on the march.
Indeed.
So no, I think the Fed's expected to not alter anything go ahead with that 25 basis points.
All right. Let's move on, Mitesh. Let's get Mitesh back in. Mitesh, the markets couldn't see a follow-through. Last two sessions were good, but we're still holding around the 24,200 odd mark. I think the first support level comes in at around 24,070. And then, in fact, we look at lower levels. But how do you trade this market?
Good afternoon, Nigel. Yesterday, I don't think I would have given an answer if you would have asked me if the markets will be down 300 tomorrow. I think I would have said a clear no, but the market has surprised me on the downside. Not getting a very strong fall is suggesting that we might actually go into a situation where we retest the earlier lows and then try to build from there. Because while I was looking at 24,150 as a support area, the markets fell early in the trade. I think by about 10:30 we were down. We had a low of about 24,188. And since then, we have just, spent about next 3-4 hours without giving any kind of or attempting any kind of a bounce back. So that is not a very healthy sign. What I would want to see is that in case the market starts going past 24,250, 260, then there could be some intraday strength. But till that happens, I think as a trader, we've kind of suggested reducing positions exposures in the markets. and to wait for the clear directional trend to play out. It could be that this 24, 150, 160 might not hold, and we might see a retest of those levels, which were the earlier lows, which is closer to about 23, 850 odds. So I'm in a slightly wait and watch mode, and the bullish bias, which was the pullback, which is a possibility, appears to have faded for the time being. But let's see, we'll get slightly more cautious once we see the Nifty get below 24, 150. For the timing, I have a sell on Bosch India Limited with a stop at about 35,750. Sell this one for targets of around 34,600 or thereabouts. And the other call which I have is a buy on Dixon Tech with a stop at about 15,400 or maybe just below it, and look for targets of 16,200.
Thank you for those trading ideas. But let's get the expert in on trend. The stock is slumped despite a 39% growth in the company's top line. Mangalam joins in to weigh in. Mangalam.
Well, trend is lower and among the top Nifty losers despite a 39% jump in revenue and 47% jump in profits. What has changed? Are these results any bad? No, in line with what the company has posted in terms of a CAGR ever since COVID has started. In fact, the post-COVID to now CAGR for revenue for the company has been 37%. They reported 39% revenue growth out here, and similar is the case for the profitability as well. But the street expectations were elevated. Remember, the street was working with a number of 4,300 crores on the top line, a 41% revenue growth, and the net profit 428 crores. To that, the company has reported 335 crores. Why is it that the net profit has beat estimates? Because one, other income is 48 crore versus 80 crores. Depreciation has increased from 152 crores to 200 crores. Share of joint venture profit has reduced, and the tax expense has also increased from 86 crore to 132 crores. None of these are operational in nature. If you just take a look at the overall absolute revenue growth, 39% in this environment with a 41% EBITDA growth and 47% net profit growth, not particularly bad. The company has said that retail business has faced headwinds due to muted consumer sentiment coupled with seasonality, in that their performance has been fairly encouraging. Fashion business, that registered double-digit like-for-like growth, and beauty and personal care, innerwear, footwear, all of them contribute more than 20% to their revenues. And they've added stores, 43 new stores added, of which 34 Zudio stores, including one in Dubai, were added by the company. And they've consolidated about 25 stores of Westside and Zudio as well. The most important thing to watch out for from now would be how the company, grows Star Hypermarket, because out there, the revenues grew by about 27%, like-for-like growth at 14%, higher than every other grocery player in the industry, with 2 new stores being added. They said that this business showed all-round improved operating performance and applied Trent's playbook to the Star business, and they are witnessing strong consumer traction. So let's see how this business pans out. As far as valuations are concerned, remember, at peak the stock was trading at around 110 times. After having corrected about 23% from the top, it's trading at around 90 times. If you look at it in price earnings to growth metric, it's down from about 2.4 times to about 1.9 times as well. The next few quarters look good. Let's see, for a company that has outperformed so much, would people look at this dip as a buying opportunity, or is trend on for some de-rating?
Okay, all right. Interesting point and interesting juncture for the stock as well. Mangalam, thanks very much for the perspective over there. Let's take the conversation forward with Sudeep Bandyopadhyay, Group Chairman, IndiTrade Capital, who's with us. Sudeep, that's really the question, right? For both of these stocks, the reason I'm clubbing Trent and M&M together is that if you look at the numbers optically, nothing is wrong with them. Growth rates are high, margins are fine. M&M has actually increased margins as well. But the stock reaction is muted. So let's start with Trent first. Do you think this 7-8% decline, this so-called disappointment, is it justified?
Well, I think, you guys summed up pretty well. Fantastic numbers. I mean, there's absolutely no doubt about it. But the expectations were elevated. And, the valuation at which Trent is quoting, I think the margin of error is absolutely not there. So even little bit of disappointment vis-a-vis expectation has led to this kind of correction. Of course, I do believe that this is not permanent. Things will come back. And this is, to an extent, you can say, overreaction. Now, that doesn't take us away from the fact that Trent is quoting at a very elevated valuation. The recommendation of a buy, in spite of this correction today, is very, very difficult to make for me. So I don't think I will venture in that space. I will only say that, results were good and the expectations were really elevated. That's why this correction is what we are witnessing. Just to take the point on Mahindra, I think as far as Mahindra is concerned, the tractor division was supposed to lead the way, and that they have pretty much demonstrated what tractor division can do and how things, whatever they mentioned, whatever they expected, that has happened. So again, there is absolutely no disappointment as far as the numbers are concerned. The margin also improved that bit. So again, I think the valuation has reached a level where, very difficult to take it forward unless there is a major positive in the counter.
Okay, all right, so they've got that. And I guess that's the biggest problem that the market is right now grappling with, aside of all the foreign selling, is that how much more can you push stocks higher beyond current valuations. Let's actually address another major Nifty mover on the way down, Hindalco. And Nigel flagged this off right in the morning, Nigel, but it's really turned out to be a difficult day for Hindalco.
Well, that's right. Hindalco is lower as Novelis's numbers, well, they were more or less flattish. And you had the guidance as well that was pretty weak. So that was the issue with regard to Hindalco. Well, what else went on? For the past quarter, if you look at the numbers, the adjusted EBITDA was impacted by around $25 million of hit, which was the impact of the flooding that was seen in Switzerland. The other factors that hit them were, the unfavorable mix from lower automotive shipments, because there is pressure on Europe. And also excluding the flood impact, well, the adjusted EBITDA margin was still weak at around $502 per ton. That's because of lower spreads. Now, what is the problem? Well, the management going ahead, they are saying that they are withdrawing that earlier guidance that they gave, that Novelis EBITDA per ton will go to around $525 per ton. So there is pressure in the near term. The reason for the withdrawal of the guidance is the pressure on scrap spreads. Remember, China, well, they liberated its policy out there. And because of that, there is higher purchase of aluminium scrap, which in turn is pushing up prices and it will compress Novelis' spreads. Now, this is the issue for them because close to around 60% of their product mix depends on aluminium scrap as a raw material. Put that together, and also we know that Q3 is seasonally a weak quarter. Well, the street has got absolutely shocked that Hindalco has actually withdrawn its earlier guidance. They're talking about better times in FY26, but for the time being, the street doesn't like it. Sudeep, what's your view on Hindalco?
Well, I think disappointment is understandable, Nigel. But as far as Hindalco is concerned, I have been positive for a long time and I continue to maintain my positive view. Yes, this definitely is a setback, and to an extent, it is on the back of the fact that automobile shipments have kind of slowed down in Europe. And of course, there was this one-time flood incident. But, if I look at a slightly longer term, and I've been maintaining this, I think the use of aluminium is increasing in every sphere we notice, whether it's a transition from IC to EV, which is much more, EV is much more aluminium dependent and aluminium use is increasing. Every gadget we use, I think the use of aluminium is increasing. So structurally, there is a uptrend, which is going to remain in aluminium for a very long time in the foreseeable future. Under these circumstances, I think Hindalco, Novelis combined will definitely benefit. And from a long-term investor's point of view, some of these dips, some of these corrections may be an opportunity for them to accumulate Hindalco.
Sudeep, Avalon Tech has skyrocketed on the back of its numbers. Is this an EMS company that you track? Numbers look good. There's a margin expansion of 500 basis points. Top line has gone up 35-40%. Disproportionate jump in the company's profitability. Would you buy Avalon Tech for the longer term?
Well, I actually would like to go to some of the other larger players in the similar space. There is this set of numbers were very good. I did have a look. But I think the stability of their earnings from the long-term perspective, I am not very sure and I can't comment on that. So if I have to look at the EMS space, probably I'll look at some of the larger competitors, larger players, and stay invested in those.
Okay, all right. So that's a word on EMS. Just look back at the screen to see, what else are the key movers and shakers of the day. KC International is actually having a good session. Remember, we had a conversation with the management earlier in the week, and it's been a slightly slow quarter. Margins have not picked up to the expectation, but they're expecting things to improve by the second half. And I think some of that has worked well for the stock. Raymond Lifestyle, what a move on the counter right now, 7.5%. I don't know if I missed numbers flashing or something like that, but big move on Raymond Lifestyle as well. So these are some stocks that are managing to buck the trend. And then there's, of course, Apollo Hospitals. Let's not forget the nifty winner of the day. The numbers are fabulous. Second quarter performance is solid. And not just that, the management's commentary today on the call with us was also very, very optimistic. They're talking about, a better profitability going ahead in Apollo Healthco and as well as the healthcare and lifestyle business. They're expecting a break even soon enough. That's 6.5% on Apollo Hospitals. Sudeep, hospitals for you? And if yes, then Apollo, do you find it worthwhile at current prices?
Oh, absolutely. I've been, liking hospitals for quite some time, and Apollo has been one of our preferred stocks. In spite of the valuation, in spite of what it has done over the last few months, we continue to believe in Apollo, and the numbers have once again proven that they have the necessary ability to scale profitably all the businesses. Even the minor businesses, they are now talking about breaking even and adding to the overall return profile. So yes, Apollo Hospital definitely. Overall hospital space also we are positive. The kind of M&A, the kind of transactions we are seeing in this space is also quite amazing. I think finally consolidation is happening, and things are going to improve even from here on. As far as the hospital space is concerned, yes, the valuation is rich, and one has to pick up this stock in this space a little carefully. But the frontline stocks like Apollo Hospital, there is absolutely no problem from a long-term investor's point of view.
Sudeep, thank you very much for joining us this afternoon. As we slip into a break, here is some exciting news for all our viewers. Seize the opportunity to attend India's landmark Iconic Summit. Show us you are a true CNBC TV18 fan by answering a simple question in our Super Fan Contest. Head over to CNBC TV18's social media channels to participate and get a chance to win a free ticket to CNBC TV18's Global Leadership Summit. Hurry, the contest ends on 10th November 2024. Answer now and you could be one of the 5 lucky winners.
Okay, welcome back. We got the market, which is down 300 points, which means that we are actually now at the low point of the day. So 24,179 is where we find ourselves at, below yesterday's low of 24,204. Nikhil Rungta is with us. He's Co-Chief Investment Officer at LIC Mutual Fund. Nikhil, good to have you with us here. Thank you for your time. I mean, the big question is, as a money manager, Nikhil, what are your thoughts? Have they changed? Are you still very much earnings focused, or this Trump victory has added one more element in your decision making? If it has, in what way? Go on.
Yeah, hi. Thanks and good afternoon to you and your viewers. So, see, we'll continue to remain earning focused. What has changed for us is basically the focus now shifts from global to domestic. With this election outcome, what has happened is one of the events is behind us now. So let's start focusing on what actually is the fundamentals. More important now is we'll have to wait and watch how exactly is the policies the new president brings in the US, how they impacts our sectors basically. What we believe, I mean, with his pre-election speeches, that there might be some or the other tariffs which might be on its way, but we might be benefiting from the supply chain in our Asia area itself. So we believe that India actually is at is one of the largest beneficiary of this election. Of course, near term there could be volatility, but historically we have seen whenever there are elections in initial 1-2 months, there is volatility, but then it stabilizes, and we have seen good returns over next 6 to 9 months. So definitely focus moves to fundamentals now.
Absolutely. And talking about fundamentals, the Q2 earnings have disappointed. They've thrown a lot of curveballs. So how have you changed your positioning in sectors post what we've seen so far?
So let me put it this way. Q2 results were, of course, I accept they were below expectation. But what has actually happened is, wherever there has been underperformance or the results are below expectations, those stocks have been hammered badly. What we have seen is stocks wherein you don't have any negative surprises. Those stocks, I mean, there are hardly any stocks or limited number of stocks which have actually fallen. And those stocks continue to do well. So this clearly proves that the margin of error actually is very small, very less in the current market scenario. In our portfolio, how we are positioning ourselves because of this result season is not major changes from portfolio positioning perspective, because these are quarterly numbers. Festival season numbers will be coming in Q3. And we are also seeing heavy marriage season coming in the next couple of months. So definitely what we have seen is your rural continues to revive, but your many companies have given a commentary of urban slowdown. But yeah, so we are actually on a wait and watch mode, how things are panning out. And of course, in your Q2, you had heavy monsoon. So that could be one of the reasons why numbers are not panning out as expected. In Q1, we had election. So we need to see how exactly the domestic economy pans out now. So all eyes on Indian domestic economy now. How exactly are the numbers faring out at the economy level as well?
All right. Hi, Nikhil. Good afternoon and good to see you in. This is Nigel on this side. You know, a couple of sectors like defense, railways, they're both pulled back, but they've had a super duper run in the last 2.5 years or so. You have had some exposure, you know, HAL, BEL, a couple of other defense names as well as part of the money that you manage. Is this providing a buying opportunity, or do you think you'll wait for a bigger dip to add on these positions that you already had earlier?
So, Nigel, hi, good afternoon. Let me put it this way. I mean, some of these stocks have actually corrected to the extent of 30 to 40%. So this actually is a right time to start accumulating them. There are definitely opportunities in these sectors, but at one point the valuations were such that you were unable to justify those valuations no matter what the order sizes were coming in. But now we are starting to see some of the other execution of those particular defense orders, and hence we might start seeing them in the numbers as well for the company. So definitely, since those are still significantly lower from their 52 weeks high. I believe this is the right time to start accumulating them.
Okay, got that, Nikhil. Hi. So on IT, where do you stand right now? Because with this whole move in the US, it's all up for debate because A, the currency is depreciating, which is good, but then companies also have hedges in place. So it's not like it's straight away flowing through to the bottom line immediately. And then, of course, this whole second guessing how protectionist will new US policies be and what happens to visas and stuff. So what's your sense right now? What's your stance on the sector? And would you change it at all, increase or decrease allocation going with this Trump win?
So as of now, let me put this way, we are equal weight on the IT sector. Definitely there are both positives as well as negatives. Your currency will depreciate, but you have hedges in place, so it won't flow to your bottom line. And on the other hand, because of these visa issues, there might be some impact on these companies. But you see from the other perspective that once the US economy start growing domestically, then there is significant amount of demand which might crop up for these companies from US. So that is where things will start moving on, but definitely that is a couple of quarters away from here. So what we'll see is at least for next 1 to 2 quarters, things will remain as it is. We are more or less at equal weight positioning in IT, and the 3Q quarter commentary which comes out in Jan month, that would be very important for the sector as a whole. So we are at equal weight and on a wait and watch mode now, how things pan out.
Nikhil, some of the quality banks like HDFC Bank, ICICI Bank reported good numbers this quarter. Did you add to any of your positions? Would you recommend buying at these levels?
Yes, so we are now bullish on the larger banks, be it private or public. And we are overweight position on the banking sector. On the NBFC side, we are bullish on non-personal lending NBFCs. Specifically, I mean, basically those more of pick and choose on the NBFC side, but on the banking side, we are definitely bullish. Earlier, we were of the apprehension that once the rate cut starts in India, these banks might start seeing pressure on their margin. But what we have seen is the governor stating that the change in stance doesn't mean rate cut is on the cards. So, and what we see on the inflation numbers in India is that rate cut might not be around the corner. And also the recent numbers on the deposit and credit side, we have seen the deposit growth rate have already overtaken credit side. So definitely now banks are in a better position to manage their margins as well. So that was our worry. And these are all the green shoots which are visible, and hence we are positive on these larger banks.
Okay. All right, Nikhil, we'll leave it on that note for this afternoon. Thank you very much for joining in. Well, that's a view from LIC Mutual Fund. But let's now head to Hormaz, who's been going through a pretty interesting report that's come in from Citi. With Donald Trump all set to return to the White House, Citi researchers note highlights the impact that Trump's presidency could have on various aspects of global as well as the local market. Over to Hormaz for more.
Now, one of the biggest and the most anticipated events of the year is finally out of the way. Donald Trump will now become the 47th president of the United States, and that can have far-reaching consequences across sectors and asset classes equally. Now, Citi has come out with this note on how this Trump presidency can impact various aspects from sectors to fund flows and then to our own markets as well. They'll take you through them bit by bit. Now, for the fund flows bit, Citi says that it is contingent on China because any big stimulus announcement that comes out from there can increase the rotation of this trade out of India into China and vice versa. Now, it wants to focus on domestic flows as well, particularly after the 10% correction that we have seen on the Nifty from the peak. Now, it sees a limited impact on the domestic-oriented economy, but sectors like pharma, chemicals, IT services, and auto ancillaries are the ones that can be impacted. Now, for the chemical space, India accounted for nearly 5% of the organic and miscellaneous chemical exports to the US, and the impact of that will depend on the tariff levied on specific products, if any, and vice versa as well. Now, for the auto ancillary space, the China +1 policy can benefit stocks like Sona Comstar, Balkrishna Industries, Samvardhana Motherson and Bharat Forge, but that is subject to how the relative tariffs change within the sector itself. Now, for the pharma space, Citi says that the Western biopharma companies are looking for vendors beyond China, and stocks like Divi's Laboratories are better placed compared to its peers due to the costs and the capacities that it has. Now, while a Trump presidency was said to be negative for Indian IT, Citi believes that the companies are now better positioned to deliver more via offshore post the COVID pandemic. Now, it also wants to watch out for any potential tax cuts and the impact that it can have on any of these stocks. Now, the result is definitely a negative for the metal sector, just for the threat of the increased tariffs. But Citi is unsure whether any of this higher stimulus from China to offset this can lead to upgrades for Indian steel stocks, which have already run up quite a bit. Now, Citi also says that the Trump presidency is negative for oil prices, and that reinforces their conviction to maintain their buy recommendations on OMCs like HPCL, BPCL and Indian Oil compared to its neutral stance on stocks like ONGC. Now, the brokerage draws upon the 2016 election that Trump had won. Now, while Indian equities had delivered 23% returns in US dollar terms over the next 12 months, sectors like energy, telecom, materials outperformed, while IT, healthcare and consumer discretionary were the underperformers. So what does that do to our own markets now? The Citi believes that despite the correction that we have had, valuations are off the highs, but they still remain above historical averages. It prefers buying the dips, and its September 2025 target implies a 4% upside on the Nifty currently. So there you go. Donald Trump, the 47th president of the United States and a disruptor for multiple sectors. For India, it's more a case of you win some, you lose some.
All right, Harmaz, thank you very much. 4% all the way till September 25. That's a long period of consolidation that a lot of newer investors perhaps in the market would not be used to. Interesting view coming in from Citi. Thank you very much for joining in. We'll take a quick break on that note, come back on the other side, and then, of course, we'll get you some final trading ideas with Mitesh.
Welcome back. Let's turn our attention now to the primary market. Niva Bupa Health Insurance's 2,200 crore IPO opens for subscription. And already in the first half of the day, it's seen some good subscription. Yash joins it with the numbers and a quick comparison with Star Health. Yash?
Well, if you look at the IPO Niva Bupa, that is expected to have a market capitalization of about 12,580 crore. That's at the upper end of the price band. There's already a listed player in the standalone health insurance space, and that is Star Health Insurance. Star Health Insurance is much, much bigger than Niva Bupa Health Insurance, but here's a quick comparison as far as the size of the business itself is concerned. Niva Bupa collected about 3,800 crore rupees in terms of net earned premium, whereas Star was over 3.5 times bigger than Niva Bupa, nearly at 13,000 crore rupees. Niva Bupa made an underwriting loss of about 410 crore rupees, whereas Star stood with an underwriting profit of about 90 crore rupees. Niva Bupa's operating profit was about 188 crore. Star Health was nearly 4 times bigger at 731 crore. Star Health's combined ratio is better by about 200 basis points as compared to Niva Bupa. And finally, Niva Bupa's net profit was 82 crore rupees, which was 10 times smaller than that of Star Health Insurance. Now, in terms of market share, Niva Bupa's market share amongst general insurance companies was 2%, and amongst standalone health insurance companies, that stood at 17%. Whereas Star Health's market share was 5% and 46% in both those two categories. But the smaller size has been bringing much stronger growth for Niva Bupa Health Insurance. Niva Bupa's net earned premium, that grew by 43% in FY24 versus Star's growth of 18% here. Niva Bupa's underwriting loss reduced by 20%, whereas Star's underwriting profits, they went down by about 1.3 times. Niva Bupa's combined ratio, that increased by 154 basis points. Star's increased by about 134 basis points. Now, the most interesting part, Niva Bupa's market share amongst general insurers grew by 35 basis points versus Star's market share, that grew by 22 basis points. But the real story is amongst the standalone health insurance companies. Here, Niva Bupa's market share, that grew by 141 basis points. Remember, a growth of 141 basis points, whereas Star's market share, that declined by 330 basis points. So, growth certainly in favor of Niva Bupa, but size in favor of Star Health. What does that do to the valuations? Niva Bupa is coming with a valuation of 6.13 times pre-money and 4.72 times post-money price to book. Star Health trades at exactly the same valuation, 4.73 times price to book value.
All right. Yes, thank you very much for that. That's a pretty comprehensive snapshot view of where both really trade at, well, the valuations they're sort of trading at. One, of course, is coming at that the IPO market. The other, of course, is already listed. So the second standalone health insurer to make it to the market now. Well, Mitesh is now with us to run us through what he's making of the decline. I mean, not very much improvement around yesterday's low of about 24,200. Mitesh, what do you have in terms of trades?
So, Prashant, in fact, last 3.5, 4 hours, it's been very flat, a market about 50 odd point kind of a range for the Nifty. To me, that's not a good sign. I think, we'll explore some shorting opportunities. BTST on Grasim, I would recommend with a stop at about 25.81 for targets of 25.30. And the pharma names also have come under some kind of pressure from the upside. So, STBT on Lupin with a stop at 21.30 for targets of 20.90 can be explored.
Okay, all right, Mitesh, thanks a lot for that. Well, let's focus on Mahindra & Mahindra. That's been one of the big outperforming stocks in the last 12 to 18 months. However, today it came out with a set of numbers that appeared quite good, though the stock is seeing some selling pressure. Sudarshan joins us to help us out with the fine print. Sudarshan, they went ahead, I think they upped their guidance as well on a couple of parameters, but it seems the street was positioned long and there is some profit taking that's taking place. Tell us more.
So stock might have come off highs, but there is nothing to complain as far as earnings are concerned. Earnings are beat against our estimates, and not only in the auto segment, but both the segments have done better than estimates, and even growth has been higher year on year. Talking first about the numbers, revenue has increased 13%, even profit has increased 13%. EBITDA has seen an increase of almost 31%, and margin is up almost 200 basis points. And talking something about like some details, company is number one in SUVs with revenue market share is at 21.9%, which is an increase of almost 200 basis points if you check year on year. Even in the tractor segment, market share is at 42.5%. Here also increase is of 100 basis points. And in electric three-wheelers also, companies say it's a number one player with market share currently standing at 43.6%. Now, talking about the outlook for the auto segment, company has maintained its growth outlook of mid to high single-digit growth. But for the tractor segment, earlier growth guidance for FY25 was of 5%. Now, company has increased it. And now the growth for FY25 is seen in the range of 6 to 6.8%. Just for the reference purpose, for consolidated numbers also, if I want to mention, revenue has increased 10%, EBITDA is up 24%, and margin here also is higher 200 basis points. So overall, earnings are good. Even outlook for FY25 by M&M is healthy.
Okay, all right. Thanks a lot for that. So no worries with the numbers. It appears some routine profit taking. Amrish, I want to know your pick for the day, but tell us first, what's your view on Mahindra & Mahindra?
Overall, if you're talking of the auto space, including Mahindra & Mahindra, at this point of time, I would be slightly cautious looking at the sort of sales, which have been happening. People seem to be happy with the sort of October sales which you have seen. But then we should remember that last year, Diwali was in November, not in October. And this time, all the sales have happened in October. So November sales, I think, could be lower than expected overall. And the inventory still is not getting cleared. So I think at this point of time, one should be a bit cautious as far as auto space goes overall.
Amrish, hi, afternoon. Any Trump trades for you?
Good afternoon. Trump trades, I would surely play the China plus one story. And that, I think, will play out majorly into the specialty chemical space. So I think that's one space on which one should be bullish. So stocks like Deepak Nitrite clearly would be a buy for me.
Okay. Deepak Nitrite. Blue Star is under pressure post its Q2 conference call. Upasna was listening in and she joins in with the key highlights. Upasna.
Well, the stock has recovered a bit after the good con call commentary by the management. Now the management remains optimistic about growth in FY25. It has maintained its margin guidance for the UCP segment at 8.5% and EMP segment at 7.5% for FY25. Now coming to company's first segment, that is the EMP segment, the management has highlighted that the manufacturing and data center business continue to be the growth drivers here. European market continues to remain slow, and company is waiting for post-election impact in US markets, and it expects the order momentum to pick up in next 18 months. Now, next coming to the company's UCP segment, which mainly comprises of RACs and commercial refrigerant business. Company says that it has been an excellent quarter for RACs, while commercial refrigeration pulled down the overall growth to 5%. Now, market share in commercial refrigeration stands still at 30% versus 13.7% in RACs. And in RACs, the company has said that the volume growth for Q2 remains at 27% and revenue growth remains at 25% on a one-year basis. Now, in RACs, the company has outpaced the volume growth seen in industry, which is at 17% versus the company has reported the volume growth of 30%. Now, in commercial refrigeration business is where the pain lies, and company has highlighted two factors impacting this. Company says that the growth has slowed as production and sale of water coolers saw major disruption due to BIS norms and delay in the production of the new top deep freezers. Now, coming to commercial refrigeration, the company has also said that this is a temporary hiccup and things are expected to normalize from here on. And even October showed positive trends. Now, lastly, company's last segment, that is professional electronics, company said this also faced some setbacks as there was a supply chain restriction and uncertainties which resulted in the long delays in the finalization of orders. But company expects the growth to revive Q4 FY25 onwards.
Okay, all right. Thanks very much for that. So, yeah, not that cool a quarter, shall we say, for Blue Star because of the commercial refrigeration business really struggling this time around, 5% down on the stock as well. Thanks for that, Upasna. Amrish, hi, good to have you on. So, Blue Star, would you look to buy the dip? Because otherwise, there's no issue with management quality, etc. But yeah, they've had a bit of a rough patch in the second quarter.
Yeah, but then, I mean, if you look at the market overall, I think there is still a lot more to go. So at this point of time, I may not really, plunge in and buy Blue Star despite the sort of a correction which we have seen. I think we can see some more. So closer to about 1450, 1480, I think that could be the level to get in.
Okay, all right. What we'll do is we'll take a quick commercial break here. Ambrish is with us. More numbers are coming in, thick and fast. I think in the last 45 minutes, 3-4 earnings have come through, and we'll sort of get you details on those as well. NCC is the latest to report. Stock spiking as we speak, 4.25% higher. Revenues are up 10%, but I think margins are looking better. EBITDA is up 46%. That's a... I don't know, I'm not sure if we had estimates for NCC, but on an actual year-on-year basis, it's a big improvement, and some 200 basis point improvement in margins as well to about 8.5%. So that's the spike on NCC post results. We'll take that break. Ambrish is with us, and more conversation on the other side.
Welcome back. We were just highlighting some of the companies which came out with their numbers in the last 1 hour. NCC is one where the profits more than doubled, aided by margin expansion. Remember this one, the stock did very well after the election verdict came out, and there was hope about Amravati and how NCC will be a beneficiary, with Chandrababu Naidu being a key player in national politics. So NCC's numbers too are matching up, 3.5% higher. Page Industries is the other one. The stock is reacting to its Q2 numbers, 2.7% higher on Page Industries. And the third one is Escorts. Let's pull that up. Escorts reported a flat revenue growth, but there was, I think, a pickup in the company's profitability. But the top line was absolutely flat. We have Yash with us to talk about PB Fintech. That's up 5%. Yash?
Well, PB Fintech has been running strong in trade today, and that's been a combination of not one but three things. Day before the numbers came out, we had told the street yesterday that the numbers on the top line front was still finding their feet because they were sort of normalizing. But operationally, the numbers are very, very strong. The move did not come yesterday, post which there was a very strong commentary which came from the management as far as the earnings call is concerned. And today, there have been some positive brokerage commentary as well as far as the stock and the growth going ahead is concerned. One of those brokerages has come from Jefferies. They've retained buy call on the stock with the target price has been raised to about 2,000 rupees per share from earlier 1,800 rupees, was Jefferies says, and they headlined this report saying that the growth momentum is unabated and renewals are stacking up for PB Fintech. As far as the growth momentum is concerned, they say that the growth momentum has been aided by strong core online premium. Strong growth in renewal revenues also aided the EBITDA margin expansion. And finally, that same strong growth in renewal revenue has offset the drag as far as the credit business is concerned. What they've done through this report is that they've raised their DCF growth by about 100 basis points, and they built a growth of 31% in their DCF over FY25 to 29 estimates, and a 20% growth for the next 5 years in the DCF based on these parameters. So it's a combination of three things: strong business momentum as far as the operational performance is concerned, strong commentary from the management, and positive brokerage notes on the company going ahead today.
Okay, all right, got it. Thanks for that, Yash. Yeah, we're trying to hold on to whatever little bits of green we're seeing, because otherwise today is one of those rare days. The market falls, but today you cannot talk about any sector that's bucking the trend. From real estate to metals to commodities to, barring PSU banks, thanks to an SBI, a little bit of a green tinge over there. Nothing else. I mean, the entire market is down sectorally. Maybe we can fire up a sectoral heat map as well and tell you the picture, because as far as the Nifty indices are concerned, nothing, almost nothing is on the positive side today. There you go. Look at the extent and the diverse nature of this fall as well. It's not too much price damage, but it's just taken the entire market down today. That's what we are literally talking about. Amrish, as we are wrapping up, let's talk about PSU banks. That's the only little green that we are getting. A lot of hopes pinned on SBI now in terms of earnings. And I know that I think PNB is a stock that you've been liking as well. What thoughts?
That's the second largest public sector bank with over 10,000 branches, 12,000 ATMs across the country, overseas operations in UK, UAE, and a couple of neighboring countries. And earnings have been improving, after a couple of bad years. And we have seen Q2 numbers were excellent. And now I think it's positioned for good future growth. Record net profit in Q2 about 32% higher Q on Q, 145% higher Y on Y. It's about 4,700 crores of profits. Deposit growth also was better than expected at about 3.6%. Gross NPAs have improved by 50 bips. It's down at 4.48%. Net NPAs are down 14 basis points Q on Q. And the management also has guided for NIMs of about 2.9 to 3%, which is slightly better than what the market has been expecting. And the gross NPAs should in fact come down to 4% by end of FY25. So here my price target works out about 136 based on an EPS of about 21 for FY26, which is about 1.2 times adjusted book value.
Yeah, I remember even when the update came out, when a lot of lenders are grappling with rising credit costs and all, PNB came out with improvement in asset quality, and it's sort of going against the tide in that sense. Got that, Amrish. Thank you very much for the pick and for being with us on the show today. Really appreciate it. But for now, we'll start counting down to what has been a disappointing session for the Bulls. They would have hoped for an encore, but that's not what they got after yesterday's major Trump trade move. About 300 points down on the Nifty. That's a 1% decline. The bank Nifty is down about 1% as well. Mid-caps at an index level, they've done better. The mid-cap index is down only 0.5%. But look at the advanced decline ratio. It's there on your screens. You can see almost 1,600 stocks declining on the NSE and less than 900 advancing. So overall, mid-cap markets have also been weak. Like I'm saying, it's sort of all sectors fall down today. Hindalco, 8.5% because of Novelis's guidance issues. Trent, market not happy with the pace of growth or the quantum of growth. And then there's a long list of losers. Shriram Finance, Grasim, Adani Enterprises. No luck today for IT companies as well. They could not hold on to the positivity from yesterday as well. Power Grid, weak trends in terms of numbers. It's just a long list of losers out there today. Apollo Hospitals was a bright spark, 6.5% after the Q2 numbers. And State Bank of India, like we were just discussing, some of these PSU banks, I think this is pretty much the only green on the Nifty today,
That's State Bank of India reports numbers tomorrow. On the, sectorally, the metal index took the hardest hit. So 2.7% gone on the Nifty metal index. The Nifty Pharma was down 1.7%. Realty under pressure, auto down 1.3%, and the IT index too gives up. Yesterday it rallied 4%, but today the fall in the IT index is down about 0.47%. But there could also be the little bit of caution or overhang of the impending FOMC decision, which will be out later today. A quick word on the broader markets. Mid-cap index ends in the red, down nearly 0.5%. Jyoti Structures, Vedanta, Samvardhan, Motherson, a couple of metal names like Nalco, weak in trade.
All right. I think it's been a down day and 24,194. I think the adjusted close should be around the sort of lows yesterday. So it's been a poor session, and I think poorer than what one thought. Even as we were expecting the market to be a little to cool off a little bit after yesterday's very sharp move. Actually, the last 2 days of very sharp moves. And maybe this was a little larger in that sense. So it's been a reversal, but I think tomorrow, the last session, it becomes important again. Weekly closes in that sense, and of course, you'll also be reacting to what the Fed does and says. There's going to be somewhere around midnight our time when that decision actually comes through. Well, I think it's a wrap on this edition. A closing bell from all of us here is goodbye. Thank you very much for staying with us. But Markets Forward is coming up. It'll take you through what you need to know as we prepare for tomorrow. Stay with us.